is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. HSBC shares rally after the bank crushes estimates and says it will repurchase as much as $2 billion of stock, while the Chief Executive Officer Noel Quinn tells Manus Cranny exclusively there may be more to come. JP Morgan agrees to acquire First Republic in a government-led deal for the failed lender. The takeover comes as Morgan Stanley is said to be planning 3,000 more job cuts as deal-making slumps. And the Aussie dollar jumps after the RBA unexpectedly hikes rates. Stocks are mixed as the Fed prepares to meet. And Treasury Secretary Janet Yellen says the U.S. risks running out of cash as soon as June the 1st. Now, we're just getting some breaking news. We have quite a lot of data. April manufacturing data, PMI coming in at 45.8. That's a touch above expectations, but also the ECB is saying that banks have tightened their credit standards more than expected in the first quarter. Now, this is an extremely important data point because this is the first time that we really hear from what happened in March. So we have manufacturing PMI for the month of April for the euro area. That's a touch better than expected. Now, what that means for ECB going forward, look, the ECB is saying that euro area banks have curbed credit by more than expected, could really weigh on its thinking. It could also slow the pace of its interest rate hikes. So let's get a look, or let's have a look at what a lot of these markets overall are doing. The other story we're watching out for is, of course, HSBC and a lot of the banking story. HSBC, for example, predicting its wealth revenue recovery will continue. So this is a picture across the board. We started the day higher when it came to European stocks. It's now down 0.3%. S&P futures also slightly lower, and then Aussie dollar 66.95 after we heard from the RBA. So HSBC shares, if we get onto the banks, HSBC shares are rallying after the lender beat first quarter estimates and announced a $2 billion buyback. The Chief Executive Officer, Noel Quinn, also commented on the global impact of the U.S. banking turmoil. Well, he spoke exclusively to Bloomberg.
I'm really pleased with the transaction that took place over the weekend. That helps to stabilize the regional banks in the U.S. So I do think these are challenges as we go from one era to another, but I don't believe we're anywhere close, or it's not going to become a systemic issue globally.
Well, joining us now is Bloomberg's finance team leader for EMEA. He is Tom Metcalf. So, Tom, good morning. Again, HSBC, I mean, stellar results. What were the main takeaways?
Yeah, you can look at those shares shooting up. I think just across the board, it's probably a set of results management are very happy with. For me, it's that buyback that's probably most pleasing shareholders. But ultimately, you know, the big story about HSBC is with its top shareholder, Ping An, right? And these set results, good as they may be, doesn't necessarily resolve anything there. And you've got the AGM on Friday. So I think the big story this week will still be what happens then.
Okay, so what happens then is also a question that we need to ask ourselves after the March term. Also, with the First Republic deal, I don't know whether we focus on JP Morgan saying now it's such a huge bank, or whether with First Republic, at least it takes care of the lost problem child. Yeah,
well, clearly regulators made the call. It's better to have JP Morgan grow even bigger and basically be able to take First Republic off effectively regulators' hands. So that's kind of why JP Morgan won it. They were able to go in and just say, we will take all these deposits, all these loans, and basically allow business to continue as usual. Other bids, we understand, were a bit more kind of reliant on regulator help. So that's why that decision was reached. But yes, the big question now is, you know, JP Morgan's bigger than ever. What does that mean, you know, for the wider US financial system?
And then we have cuts at Morgan Stanley, and that could be 3,000. What did it tell us about investment banking this year?
Yeah, that is the area that's probably got to be most concerned by this. You know, Morgan Stanley have come out and effectively saying, we're not going to be cutting wealth management, we'll be cutting banking and trading. Trading's still doing pretty well. So I would say most of the cuts are going to go through those deal makers, those rainmakers. So until that deal flow improves, it's going to be tough times at Morgan Stanley. But also we're seeing this at other banks as well, like Citi, even HSBC today, saying they're, you know, sort of monitoring the situation. So I expect a lot more job cuts to come, I think, in investment banking.
Tom, thank you so much. Tom Metcalf there, who's, of course, in charge, our finance team leader for EMEA. Now, ahead of the ECB's policy decision this Thursday, investors will be keeping a close eye on the data for clues on the rate path. Last to the bunch, or in the bunch to report euro area And Italy preliminary inflation figures for April are out at 10 a.m. UK time. Well, joining us now is Nandini Ramakrishnan, EM equity macro strategist at JP Morgan. Nandini, as always, thank you so much for joining us. So we just had a couple of data points from, the euro area saying, for example, euro area banks have curbed credit by more than expected. If you look at central banks, are they looking at the credit crunch and worrying about it, or do they still have to just nip inflation?
No, I think absolutely. Mandate of a central bank is obviously one thing is defined on paper, but seeing what happens with the real economy, financing conditions is going to be extremely important for the ECB, for the Fed this month as well, because financing conditions are tightening. And that's going to be one of the more leading indicators rather than, let's say, unemployment or labor market, which are more lagging indicators in the economic cycle. So certainly, absolutely looking at financing conditions and investment objectives from corporates and investment sentiment from corporates, because that's what kind of drives the next few months or next few quarters of economic growth.
So what are you expecting overall from, a lot of the central banks? I'm thinking of ECB and the Fed, and how does translate into emerging markets?
Definitely. I think that this month is going to be, if not the last, but one of the last hikes for both the ECB and the Fed. I think they're going to be cautious about indicating any more hawkishness because of what's been happening both globally in the macro data, as well as some of the financial stresses we've seen over the past few months. So I think we're nearing to those peak interest rate points. And actually, this is boding well for emerging markets who traditionally have been a bit more challenged when DM central banks are hiking. But actually, when we've got this clear messaging of nearing the peak in DM, EM central banks actually have space to potentially even cut. We've heard from a few that they're pausing, so cutting would be even more beneficial for EM macro overall.
I mean, that has huge implications for the dollar. First of all, we're getting a bit of movement on the European bond yields with the ECB. Once again, that headline crossing the Bloomberg terminal just moments ago saying that banks have tightened their credit standards more than expected in the first quarter. So does it play, I mean, the more we see movements in this, how do you play it through emerging markets?
Well, the dollar is a huge sentiment indicator as well as a good temperature check for emerging markets as a whole. And the dollar, which was in our measures 25% above fair value in October last year, is now just 3 to 4% above fair value. So that huge drop in the dollar is going to provide a big boost to emerging markets, both from a global trade perspective, but also simply from sentiment, from the fact that EM economies can now import more, their currencies are stronger. So we do feel very positive that that dollar shift is going to play out this year, especially as we get messaging from DM central banks about peaks.
Nandini, so we also have, quite a lot of talk about China's reopening being well underway. And then what struck me is two speeches from Christine Lagarde and Janet Yellen talking about fragmentation. How do you model that actually? Are we underestimating the impact this could have globally?
Look, I think China is very clearly on its own cycle versus the rest of the world on an economic basis. So reopening is well underway. We're seeing data ticking up, EM earnings, especially China earnings, ticking up, while DM earnings are starting to feel a bit of that financial conditions tightening or peak interest rates. So there is a bit of economic fragmentation. But of course, there's also, we must look at geopolitics. And though that is a challenge for sometimes EM investors, it's part of the long-term story. And we do model that in terms of risk frameworks or thinking about cost of equity or various other measures we can input into our models to make sure that we're capturing kind of global landscape accurately.
Do you worry about the freezing actually of, I don't know whether the banking crisis is over, but liquidity freeze out there in the markets that could seize up? If, for example, we were to see something with the debt ceiling, that would also translate to emerging markets.
Well, I think broadly money supply globally has been higher than it's really ever been in an aggregate volume terms. So I don't worry about a huge liquidity seizing. We see that most pricing in terms of equity markets and bond markets are pretty sanguine about various slowdowns. They do seem to have quite a bit of trading volume across the world. So I wouldn't say we're worried about a liquidity issue. Also specifically on debt ceiling and some of the other concerns, though the downsides are potentially very big, there's usually been a resolution and we don't expect this to be a huge market mover, maybe a bit of volatility and headline noise around the major events. But overall this year does seem to be a year where we think that the biggest surprises are hopefully over.
And Nandini, is there something that we're underestimating? I don't know whether there are structural reforms in certain parts of EM, and therefore you look at country specific, or whether it's just the fact that AI, we don't know where AI ends up, right? And that has implications for the models you're looking at.
Yeah, I mean, there's always going to be new technology and new parts of the market that we may not know exactly how they're going to play out. But overall, it does seem like while the past few years have been dominated by the pandemic, risks of higher inflation last year, this year feels like a more traditional kind of garden variety central bank induced slowdown in DM and a big reopening play for China in EM, which should be supportive of the global ex-DM space over 2023.
How do you play geopolitics? I mean, this is the nightmare, right, for any kind of bank strategist to get to grips with.
Yeah, I think the major thing is thinking about where the economic relationships lie. Yeah. And when you hear headlines of certain geopolitics, of course, that's going to be alarming. But if you think about the trade flow between emerging markets and the rest of the world, that has increased. Globalization actually on much of the data hasn't decreased, right? There's still goods moving around. The demand for goods globally is voracious, and EM is a big supplier of that, both raw and manufactured goods. So I do still think keeping an eye on the actual data rather than the headlines is the best way to play this as a global investor.
Thank you, as always, such smart insight. Nandini Ramakrishnan, their EM equity macro strategist at JP Morgan. Coming up, IBM plans for a future where bots will take over a significant number of human jobs. We'll have more on that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, IBM is preparing for a future where artificial intelligence replaces a significant number of roles. The chief executive officer expects to pause hiring for jobs impacted by AI or automation. Well, that could account for as many as 30% of roles. Well, joining us now is Bloomberg Quick Takes Alex Webb. Alex, good morning again. So if you look at some of the comments, what are you expecting actually the impact of AI to be?
I think it's true that a huge number of jobs are going to be vulnerable to artificial intelligence. I think the interesting thing is that when people talked about automation 10 years ago, they were very much thinking about factories, that repetitive manual labor jobs were the ones that are going to be replaced by robots. Now we're starting to see that, well, robots are huge capital expenditure. AI, as we're seeing it right now, is software. It is sort of infinitely replicable, so therefore it's the more repetitive, often sometimes creative jobs that can be done by a large language model, at least partially. Those are starting to become a little bit more vulnerable.
So how much of this is actually new?
I think if you look particularly at IBM and the sort of positions they're talking about, which is, you know, as they say, back office functions, some human resource positions, they probably could have said that a little while ago. Amazon already does some human resources stuff with AI, where it looks at sort of performance in some of their warehouses, and you see people, Bloomberg had a great story on this last year, literally being fired by a bot, right? So this is something that is already happening. I think the new thing now is that CEOs are way more willing to talk about it, because everybody wants to be saying, AI, we're using AI, it's changing our business, that's great, isn't it? And it's like, well, it's good, but not necessarily if you're someone in one of those jobs.
But Alex, so the pace of change, right, could also be widely faster because of the processors than we thought even 6 months ago.
Yes, I think, look, the pace of change is largely to do with the fact that OpenAI released this product as a beta.
So it changes things.
Everybody went, oh gosh, we really need to hurry up, right?
Right?
I think in terms of the processor power, like this stuff is already going into deployment. We're seeing Microsoft talk about now expanding CapEx so that it can add more AI processing power to its data centers. That, I think, though, that is not the tail wagging the dog. That is, you know, literally, they're seeing the demand for AI, therefore they're expanding their capacity. The differentiation here is that this is going to be, for a lot of companies, a cloud product. If you want to be using these AI tools, you probably need to be using Google Cloud or Microsoft Azure. Therefore, its salespeople are going to be pushing it because they see it as a way of stealing share from Amazon Web Services.
Alex, and there's an article actually that you pointed to me this morning, which is basically, you know, just a growing number of people that really understand AI that are worried about what it becomes.
Yeah, so Jeffrey Hinton, who is a professor of AI essentially at the University of Toronto and is considered a godfather of AI, he designed neural networks, was one of the key people behind that innovation, which in itself has driven this new generation of AI that we've seen. He also had a contract working for Google. He's stepped back from that role, partially because he wants to be able to talk more freely about some of the dangers and is slightly scared by the pace of the change.
Alex, as always, thank you so much. Our Bloomberg Quick Takes, Alex Webb on technology. Coming up, Infineon breaks ground on a new chip factory, the biggest investment in the company's history. So we're live in Dresden next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News with Samuel Etienne. Hi, Sam.
Morning, Francine. President Biden has called a meeting of top congressional leaders for next week to discuss the debt limit standoff. The invitation came just hours after Treasury Secretary Janet Yellen warned the U.S. risks running out of cash as soon as early June. Since hitting the current limit of $31.4 trillion in January, the U.S. has been using special accounting measures to stave off a possible default. And anger over President Macron's pension reform spilled onto the streets of Paris yesterday, with marches across the country. The government says over 780,000 people took part in protests, while the Labour Union put the turnout at 2.3 million. Macron pushed through with plans to raise the French retirement age to 64 last month, despite widespread protests. And the US says Russia has suffered more than 100,000 casualties, including 20,000 deaths, in the bloody standoff over Bakhmut in eastern Ukraine. The commander of Ukraine's ground forces says Russian troops have been pushed back from some positions in the region, which has seen intense fighting since December. And writers of some of the most popular US TV shows are going on strike, demanding higher pay amid rapid changes in the way in which people watch films and programs. The Writers Guild of America, which has more than 11,500 members, says almost 98% of those voting last month backed the walkouts. A strike in 2007 resulted in a $2.1 billion loss in economic output. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Francine.
Sam, thank you so much. Now, the EU is aiming to produce 20% of the world's chips. Right now, it makes about 10%. Today, Infineon breaks ground on a new chip factory in Dresden, the biggest investment in the company's history. Well, joining us now is Bloomberg's Oliver Crook. Ollie, good morning. So how significant is this project?
So, Francine, we talk a lot about digital sovereignty. We talk about strategic autonomy and all these sort of things. And this is the reality of that. This is literally what needs to happen to get it done. And so Scholz and von der Leyen are coming here to inaugurate this groundbreaking. So a lot of fanfare, a lot of big commotion for a very little thing. These chips that go into everything that we use, everything from our cars. In Germany, obviously, that is one of the main focuses. The average car has 1,400 chips in it. And so here, Infineon has already got 3 fabs. They're already building. Now this is the 4th. Saxony, this region of Germany. So we talk about Silicon Valley. London has tried with the sort of silicon roundabout. Silicon Saxony actually produces 1/3 of all of the chips that Europe that creates. And really, they want to double their capacity. They want to do 20% of the world's chips within Europe. And that is an absolutely monumental task. And these are the kinds of chips that go into not just the EVs, but also into the wind turbines. So it's at the center of these 2 major industrial stories in Germany, digitization and the energy transition. Without this, you have no future.
So the EU wants to more than double their chip output. I mean, this seems so hard to do, Ollie. Is that even possible?
That's right, and that's why von der Leyen is here. Scholz is going to be coming here, and really, this is what we're going to talk to the CEO about in just a few minutes. Can Europe actually achieve this? The political will is there. Some of the money is there. The EU Chips Act, 43 billion euros going into it. But you run into some of the same risks that you have with the Inflation Reduction Act. Will you have a race to the bottom with the U.S. and everybody trying to attract all these companies? Germany is still trying to bring TSMC and Intel here, putting up billions of euros of subsidies. companies. And then you have the question of jobs. Do you have the skilled labor to bring all of this stuff to fruition? This will create 1,000 jobs here in Dresden, but do you have the technical capacities? And with that on the back burner, you have the simmer of this sort of tech war between China and the United States, U.S. putting up barriers for China to be able to produce these sort of advanced semiconductors. Could that have a knock-on effects and really dent the chip industry going forward?
Ollie, thanks so much. Oliver Kirk there with the very latest from Dresden on chips. Now, we'll also hear from the Infineon's chief executive a little bit later on that interview, 10:40 a.m. London time. Now, the ECB has said that euro area banks have curbed credit by more than expected. Credit standards have tightened further substantially in the first quarter. That's according to the ECB's bank lending survey. The decline in net demand from firms was actually more than foreseen by the banks in the previous 3 months. And again, this is extremely important. It is moving German bond yields because the poll is also the first to offer some pretty concrete indications about the knock-on effects of Silicon Valley's March demise and Credit Suisse takeover by UBS a little bit later on. Now, what that means is that the tighter lending conditions were also driven by banks' perception and tolerance of risk, while the ECB's rate increases also played a role. That's according to the report. We'll have a look at what that means for whether they need to update their call on 25 basis points. Certainly, I know Bloomberg Economics is looking at this composite indicator to see whether anything changes going forward. Let's also look at the banks. We have quite a lot of bank news. Not only is the bank news about HSBC with some pretty stellar performance, the banks also in focus after the Citi chief executive said she's willing to adjust staffing levels in the investment bank. And coming up, HSBC announced that it would buy back as much as $2 billion of stock. This is Bloomberg. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Banks in the Eurozone curbed lending more than anticipated after borrowing costs jumped amid the banking turmoil, reinforcing calls for the ECB to slow the pace of its interest rate hikes. HSBC shares rally after the bank crushes estimates and says it will repurchase as much as $2 billion of stock. Well, the chief executive officer, Noel Quinn, tells Bloomberg exclusively there may be more to come. And JP Morgan agrees to acquire First Republic in a government-led deal for the failed lender. The takeover comes as Morgan Stanley is said to be planning 3,000 more job cuts as deal-making slumps. HSBC shares rising after the lender said it would buy back as much as $2 billion of stock as it reported first quarter results that smashed estimates. Well, the chief executive officer, Noel Quinn, spoke to us exclusively on his outlook for the bank for the rest of the year.
The strategy is working. I'm really pleased that we've reinstalled the quarterly dividends. So we've announced today a quarterly dividend of 10 cents per share. That's the same level that we had pre-COVID. I'm pleased with that. And at the same time, we've also been able to announce a $2 billion buyback. I think the business is well positioned going forward for sustainable profits, sustainable returns, and an ability to generate a lot of capital that can be returned to shareholders via dividend and via buyback. I think that's the most important thing I'm focused on for all of our shareholders, including Ping An.
The $2 billion buyback that we see today, is that step one of a material series of buybacks?
Well, I think we were originally planning a buyback in the second half of the year, but because of the positive business performance we've evidenced in Q1, we were able to pull that forward to Q1. I think what I think we see going forward is continued sustainable profits, and therefore the potential for a series of buybacks. We've always said that buybacks have a place, and they have a place alongside dividends to distribute excess capital. We want to retain sufficient capital to continue to grow the business, but based on what we're seeing at the moment, we think we have the potential for a series of capital distributions via dividend and buyback over the coming years.
You said when we took the pre-tax and stripped out the exceptional items that you were happy that this wasn't all interest business. But of course, we want to get your sense whether we are at peak interest flow for you. The Fed will meet this week, the ECB and the Bank of England. Do you think you're at peak net interest for 2023? The guidance remains steady.
I think we've had a good NII performance in Q1, but I think it's fair to say we've always said that 2023 will probably be the year that NII tops out because purely through rates. NII can continue to grow through underlying growth in the balance sheet and economic activity. But from the rates benefit, we always said 23 will probably be the peak year from a rates benefit point of view. And I think that still holds true. As you go up the rate curve, you get the law of diminishing returns kicking in on how much of those rate benefits you can hold on to versus the competitive pressure.
So if the bank is cranking on gas, the strategy is working, the buyback is in place. I listened to Goldman Sachs. I come in overnight. Morgan Stanley are cutting jobs. Jane Fraser said she's ready to adjust headcount. I think your previous CFO said the only thing he worried about was costs and whether you went to bed happy at night with costs under control. Are you ready to take headcount out of the business again? I mean, it's a tough subject, Noel. Are you actively considering scaling back any of the areas? Are you ready to cut headcount in investment banking, Noel?
Manus, we've taken a significant amount of cost out of the bank over the last 3.5 years. That's what we've been very focused on in our transformation program. Our Q1 cost performance at a reported level, our costs were down around about 2%. If you adjust on a sort of a constant currency and a target basis, we were up around about 2% against a target of 3%. So our costs are well controlled. This is now embedded as a day-to-day BAU cost discipline in the organization. And that's after 3.5 years of strong focus on cost. The other thing I'll draw your attention to, Manus, in Q1, most of that cost growth in Q1 against target was all technology spend. It was digitization of the bank. So that's good spend, not bad spend.
Well, that was the HSBC Chief Executive Noel Quinn speaking to our Manus Cranny a little bit earlier today. Now, First Republic Bank is officially dead. The country's largest bank by assets, JP Morgan outbid at least 3 others in a government-led deal for the failed lender. Bloomberg's Scarlett Fu has the details.
JP Morgan's Jamie Dimon knows a thing or two about buying troubled banks. 15 years after his firm took over Washington Mutual and Bear Stearns, JP Morgan won a government-led auction to acquire First Republic Bank. It's a deal that makes JP Morgan, already the largest U.S. bank, even larger, while also minimizing damage to the FDIC's fund that guarantees all bank deposits under $250,000. As part of the agreement, JP Morgan and the FDIC will share the burden of losses and any recoveries on First Republic's mortgages and commercial loans. Now, in the same way that Silicon Valley Bank targeted startups in the Bay Area, First Republic catered to wealthy clients in coastal cities. It offered them jumbo mortgages, took in their deposits, and gave them 5-star service. This strategy worked incredibly well when interest rates were super low, and First Republic's deposit base jumped 5-fold in the past decade. But when the Federal Reserve began aggressively increasing interest rates last year, those same wealthy depositors started pulling out their money to get higher returns somewhere else. That forced First Republic to pay out higher rates to keep those deposits from fleeing, at the same time that the Fed's rate hikes were reducing the value of First Republic's mortgage portfolio. SVB's collapse triggered fears that First Republic wouldn't be able to meet withdrawals from depositors without unwinding its portfolio holdings at a loss. The stock tanked, which led to more withdrawals. With JP Morgan now the new owner of First Republic deposits and assets, there is a chance the banking turmoil is close to its end. And as the last big bank CEO standing from the financial crisis, Jamie Dimon says he sees the banking system as stable now.
Well, that was Bloomberg's Scarlett Fu on the demise of First Republic. Now let's get straight to a Bloomberg Business Flash with Sam Etienne. Hi, Sam.
Hi, Francine. BP has slowed the pace of share buybacks as lower energy prices trimmed cash flow. The London-based energy giant beat profit estimates thanks to a strong oil and gas trading performance. Despite this, the surplus cash flow it uses to boost investor returns shrank by about 40%. BP says it will repurchase $1.75 billion of shares in the coming months, down by $1 billion from the prior period. And tech giant IBM says it will pause hiring for back-office roles it thinks could be replaced with AI in the coming years. Of 26,000 non-customer-facing roles, CEO Arvind Krishna says 30% could be covered by AI and automation over the next 5 years. IBM currently employs about 250,000 staff worldwide. And Qantas Airways has named Vanessa Hudson as its next CEO, making her the first woman to lead the airline in its more than 100-year history. Currently CFO, she'll take the top job in November. inheriting an airline delivering record profits, but also facing strained relations with customers and unions. And Bloomberg has learned that Morgan Stanley plans to cut 3,000 more jobs amid a deal-making slump. The banking and trading group is expected to shoulder many of the reductions. CEO James Gorman said last month underwriting and mergers activity had been subdued. It's the American bank's second round of job cuts within 6 months. Francine, that's your Bloomberg Business Flash.
Sam, thanks so much. Coming up is the worst of the UK's inflation shock. Now, in the past, we checked the state of the British consumer next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, UK shop price inflation has slowed to 8.8% in the year April from a record high of 8.9% in the previous month. The data from a British retail consortium suggests that British households may be past the worst of the inflation shock. Well, we also had manufacturing PMI for April within the past few minutes coming in stronger than expected. Well, here with us, Alex Brazier. He's managing director and deputy head of the BlackRock Investment Institute. Alex, as always, thank you so much for coming in to make us smarter. I have 1,000,001 questions about inflation data and what central banks do. Is there, first of all, a little bit of a misnomer in the markets that they're trying to figure out what central banks will do without really understanding the trajectory inflation takes?
I think that's probably right. There's no clear narrative right now about how things are evolving. And there's lots of focus on the growth data, as there always has been. But really, we mustn't lose sight of the fact that the defining feature of the world economy right now, certainly in developed markets, is the persistence of inflation, which reflects the fact that those developed markets are overheating because of a mixture of labor supply problems. We've seen it from the US to Australia, all of which mean central banks are raising rates into slowing economies and in all likelihood won't come to the rescue as economies slow further later this year.
So is the UK ahead of, the Fed or the US in terms of some of the concerning trends that we could see in inflation, or does it just mirror but it's exacerbated because it's a small open economy?
Yeah, I think some of the features of the UK are actually lagging the other economies. So for example, retail energy prices are staying higher for slightly longer than in some of the other economies. And that's exacerbating the UK's headline inflation picture. But the thing they all have in common, the UK, Eurozone, US, is that labour supply issues of varying sorts mean their economies are fundamentally overheating. They've got strong wage growth. As a result, they've got strong core inflation. And they face this very difficult trade-off of slow their economies further with rate hikes that they've undertaken in the fastest rate hiking cycle since the 1980s, or live with more persistent inflation. And it's clear that in Europe, central banks are very determined to get inflation down. The Fed has been talking tough, and we'll see this week whether it carries through on that.
I mean, I guess the concern, which is why the markets are a bit muddled up, is also they don't know quite what to do with a possible credit crunch because of the banks, and we had this ECB lending also survey coming out. So is it difficult for a central bank to say, look, this is a market, or this is the bank crisis and what that means for a credit crunch, but inflation is still what I need to fight?
That's right. So the credit crunch, certainly in the US, possibly given this morning's numbers to some extent in Europe, you can think of it as doing some of their work for them. It is probably a consequence of the fastest rate hiking cycle since the 1980s. And in that sense, it's almost by design that central banks wanted to tighten credit conditions. So this isn't the old playbook where tightening credit conditions means central banks come to the rescue. This is the other way round. This is where central banks have deliberately raised rates to deal with overheating economies, get inflation down. So when it happens, they don't come to the rescue from it. This is part of their design in a way.
And is this a new normal? And I don't know whether it actually matters whether we think we're going back to the way it should be, this is like 12 years ago, or whether this is a new reality and whether that changes market psyche.
Yeah, we think it's a new regime in general, and you can always be cautious of people calling new regimes, but in a way, that 20 years of great moderation was in fact an aberration. Supply, labour supply, energy supply, goods supply was inexorably growing. So the job of central banks was always just to stoke up demand, to keep it growing in line with supply. Now we're moving into a regime in which we're going to see more frequent supply disruptions. That doesn't mean supply chains necessarily. It means labour supply, energy supply, and even the rewiring of global supply chains all mean more frequent disruptions to supply. And that presents central banks with a much more difficult job than they had for 20 years. They're faced with this choice of keep slowing economies to keep them in line with constrained supply capacity or living with persistent inflation.
Which one would you choose? And also the 2% inflation target, is that still the right number?
I think 2% inflation is still the right number. But what's missing here is a debate about when you face this trade-off, what is the right speed with which to return inflation to the target? You could return inflation to target very quickly, but it would be very costly. You can return it very slowly. That runs risks of losing control of inflation expectations. And central banks have kind of lurched from talking about inflation as transitory to the fastest rate hiking cycle since the 1980s. What's needed really is, in these difficult situations, these trade-offs, is an open debate about, well, okay, here we are, inflation's very high, the economy's overheating, what's the right pace to bring it back? And what's the right trade-off? Always bring it back, but what's the right pace to bring it back?
So what do you think is the right pace to bring it back? And again, why did we underestimate the sticky inflation?
Well, why did we underestimate the sticky inflation? I think it's that initially inflation was transitory. It was the surge in goods prices as a result of us all going out less and buying more goods during COVID. That's unwound. That bit truly was transitory. I think the bit that took people by surprise was that underlying labour supply problems in the US, in the UK, and in Europe to some extent, all meant that even though economic activity hadn't really regained its pre-COVID levels or trend, core inflation was the result. And so it was that underappreciation of the supply side that really mattered. And that's what central banks are now really grappling with. What's the optimal pace to bring it back? Well, the standard pace for a central bank is a couple of years to bring it down. That seems to me about right.
We don't have a couple of years, though, do we?
Well, I think if they're clear about what they're trying to do, they actually have a bit more leeway. Okay. I think having ignored the trade-off for so long, they needed to reinforce their credibility with these rapid rate hikes. There may be, and maybe this is the benefit of hindsight, but there may have been a better way to acknowledge the issue and have a public conversation about the appropriate speed with which to return inflation to target.
Alex, I know the Bank of England has also been at pains to trying to figure out why there has been a drop of people looking for work. I mean, how much of it, again, do we understand about, not enough skills out there or long COVID and kind of post-pandemic things hanging on?
Yeah, the UK seems to have more labour supply issues than others. Now, in the US, it seems to be that the natural ageing of the population and declining participation as the population ages explains a lot of what's happened to labour force participation. In the UK, there's an added effect, which, as you say, relates to long-term sickness, and the understanding of that isn't very good right now, which opens the possibility that it could recover. But right now, the UK faces a much bigger labour supply problem than many other countries, which is why in the UK we've had, on average, no growth for the last 2 years, and yet the economy is still overheating. That's a puzzle on the face of it, but it's explained by these labour supply problems.
How should central banks look at AI? And again, it's always a problem of timeline, right? If we're going to see jobs displaced quite quickly, then it could change also the work dynamic.
I think it could. I think in two ways, really. One is that you always see these big structural changes in the economy, and that creates disruption, also creates productivity growth over time. And that's one thing that certainly the UK authorities will be wanting over time. The UK's productivity performance has not been great. But the other way in which it confuses life for central banks is they're trying to get to grips with what's happening on the supply side, generally. And the more disruption, good or bad, that's happening on the supply side, the more difficult their job becomes. When the supply side is growing smoothly, it's just a case of keeping growth steady. When the supply side is being disrupted in various ways, they're constantly trying to figure out in a forward-looking way, how quickly can they let the economy grow?
Alex, thank you so much, as always, for joining us. Alex Brazier, they're Managing Director and Deputy Head of the BlackRock Investment Institute, and we're also recording a special podcast of In the City that will be out on Thursday with Alex, and don't miss that coming up. Also coming up, we're looking at the key piece of Euro area economic data coming out in just a few minutes. We'll have the full analysis for you next, and this is Bloomberg.
This is a case of a small handful of banks that were poorly managed.
I think part one of the banking crisis is over. I think we have a second wave in commercial real estate.
Does it become systemic? And by systemic, we mean, does it bring down the system as we saw in 2008? I don't think so.
We want, it's in all of our interests to have a safe and sound, trustworthy, reliable banking sector.
We're anticipating a recession at the back end of the year.
I think that we are going to see now a real slowing that begins to happen to aggregate demand.
Well, guests there at the Milken Institute Global Conference reacting to JP Morgan buying First Republic Bank after it was seized by regulators. Now we're just minutes away from key pieces of data for European markets. Eurozone CPI due at the top of the hour. That's ahead of the ECB's monetary policy decision on Thursday. Joining us now is Bloomberg's Maria Tadeo in Brussels. So, Maria, a string of data already out this morning, more coming up in a few minutes.
Yes, Francine, and we had, and you've been talking about this on the show, the lending survey for European banks, and what you see overall, and this was always going to be a relevant one, whether without a monetary policy decision, because it was seen as a bellwether, almost as a temperature check of the jitters from the banking jitters that we've seen play out both in the U.S. but also in Credit Suisse. And what you see is that credit standards, quote, tightened further substantially. When you look at the data that was provided in the survey, you see that loans to consumers, to households, to firms, also housing loans, they were majorly down. Overall, what you could say is that this is a picture of cautious. And remember, the European Central Bank had said that they would look into the data, the idea perhaps that could feed into the euro system, into European banks, and therefore to the European economy. Now, taking it forward to about just 5 minutes time, we're going to get obviously CPI for the euro area. The big number, Francine, as you know, as always, as has been the trend now for months, will be core inflation. Obviously, European policymakers want to see a substantial proof that inflationary pressures, but also the sticky nature of it, is fading because of, well, we've seen play out that in the headline inflation, as soon as energy prices go down, that follows. But with core inflation, that has not been the case. It is rather sticky over the past few months.
So why, or we know why this matters for the ECB, but Maria, how much does it matter for the ECB?
Yes, and Francine, you've nailed the question, because by now it's almost granted that the European Central Bank will hike again on Thursday. But the big question mark is at 50 basis points, or will it be 25 basis points? And when you look at the data, and obviously we're waiting for the inflation data to come out in 5 minutes, but if you see one where potentially inflation cools down more than expected, in line with expectations, on top of this lending survey that points to a picture of cautious, you could argue it increases the case for a 25 basis points on Thursday hike. If you do get, and again, we're looking down and counting down to this data, if you do get a surprise to the upside on inflation, it could strengthen the case that there is still way more to go. And remember, 50 basis points, it is still at play. Deutsche Bank says this is a close call going into Thursday.
Maria, thank you so much. Maria Tadeo there with the very latest, of course, on the economy. Now, let's also have a look at what some of the banking companies have been saying, or some of the banks actually have been saying. HSBC reporting some pretty stellar results. The share price is rising, almost gaining 5%, after the lender announced a $2 billion share buyback. You know, a pre-tax profit tripled to $12.8 billion. Bloomberg Surveillance Early Edition continues the next hour with Matt Miller in New York and Edwards in London, and this is Bloomberg.
This is a case of a small handful of banks that were poorly managed.
I think part one of the banking crisis is over. I think we have a second wave in commercial real estate.
Does it become systemic? And by systemic, we mean, does it bring down the system as we saw in 2008? I don't think so.
It's in all of our interests to have a safe and sound, trustworthy, reliable banking sector.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The euro drops as the ECB says banks curbed lending more than expected in the first quarter. Inflation data is due now and will shed more light on the ECB's path for rates. President Biden and the debt limit. He's called a meeting of congressional leaders for next week as Treasury Secretary Yellen warns the Treasury may run out of cash as soon as June. And more job cuts on the way at Morgan Stanley. 3,000 positions will be cut as the bank grapples with a slump in deal-making. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Well, the news from the banking sector just keeps coming. Earnings stories dominate here in Europe. And we also have plenty to focus on when it comes to central bank narratives this week then, Matt.
Yeah, absolutely. All kinds of bank news, right? Because you've got consumer-facing bank news, you've got employee-facing bank news, and you've got central bank news that we're all watching very closely. Take a look at what's going on in terms of markets. Almost nothing at all yesterday in terms of the S&P. We were 41.69 at the close on Friday and 41.67 at the close yesterday. So very little change, and we see very little change in S&P futures today. We're down about 0.1% as investors buy bonds. So 10-year yield coming down, but still higher than where we saw it yesterday because it had come up so much. 352.81 is the level we're looking at the 10-year right now. And the Bloomberg Dollar Index is rising again. Okay, it says unchanged, but it had been down substantially earlier. So a big move to the upside once that European bank story came across, affecting obviously the euro, but also the pound and all of the other major trading partners of the Bloomberg U.S. Dollar Index. Bitcoin is coming back up from below $28,000. It had fallen below that level and now is trading at 28,037. So it had come down substantially yesterday, possibly in sympathy with tech stocks. Even though you saw little change on the S&P, you did see a bigger drop on the NASDAQ. We also saw a rate hike from the RBA, which is considered one of the least hawkish banks right now. So if they are worried about inflation, shouldn't we all be worried about inflation? You know, there is maybe less incentive for the ECB to put up a bigger hike because of that bank story. But this tells a story of central banks just not finished with fighting inflation yet. So you can see the Aussie dollar up about 1% right now. The 3-year yield, which is very sensitive to the rate moves by the RBA, is up 17 basis points and had been up even more, right now at 318.80. And then the S&P ASX 200, the benchmark index in Australia, down 9% at the close. And this is the opposite move of what we've seen in most other Asian indexes. For example, the CSI 300 on the mainland in China up 1%. So, Anna, a lot of moves here, a lot of it related, as you said, to central banks, a lot of it related to the economic numbers, and we've got some out of Europe right now.
Yeah, absolutely. So on the theme of central banks focused on inflation, that's certainly that RBA story dominated through the Asian session. And now moving into Europe, we've just got some data coming through in the euro area on the inflation front, so we'll get to that. Euro area April consumer prices rising by 7% year on year. The estimate was for an increase of 6.9%. So at the margin, I guess you could say, because I looked at the core number and that's come in pretty much in line with estimates, but I suppose at the margin you can say that that inflation print is higher than expected and looking stickier perhaps than had been anticipated. More on that in just a moment. In terms of the broader stock picture then, this is what we see across the European equity markets right now. A bit of weakness coming through. We tried at the beginning of the session to make some gains on European equity markets, and we managed it in some cases, but retreating a little further as we go through this session here in Europe, now down by 0.4% on the CAC 40 over in Paris, for example. What is weighing on markets today, though, is really the energy sector. And we had, if we could just backtrack to that list of assets we had there, we had the energy name BP reporting today. If we could just get back to that, which we can show you the share price movement of. There we are. The BP share price down by 4.5%. This after the business, yes, it reported numbers that came in better than expected, but the buyback was smaller than the market had anticipated. And some of the gains that they made in their trading business were described as exceptional. And as a result, you know, maybe not something that will be repeated. So BP, a weak spot. HSBC to the other side in London, lifting sentiment around the banking sector, a bigger buyback, a bigger profit than expected, and also the reinstatement of a quarterly dividend. All of that, a bit of a fight back against those shareholders who might have been arguing for something radical at the bank ahead of the AGM. Electrolux, this is a white goods manufacturer, of course, here in Europe. And there's Bloomberg, our colleagues at Bloomberg News, carrying a story that we could see some Chinese M&A interest. That stock up 3.5%, was up by 10 earlier on. And back to that euro story. Here is the euro, 109.77. And if we show you that session chart, we can see the impact that data that Matt was referring to around lending. This is when we got the ECB's lending conditions survey come through. And it did show that banks across Europe had tightened lending conditions more than had been expected. So if that's the case, does that mean the ECB doesn't have to do so much? So the euro dropped on that news and has since been digesting that and also the inflation print. Joining us now is Bloomberg Europe correspondent Maria Tadeo, who's in Brussels. Maria, so sum up what the data picture looks like then for us this morning. We've had quite a lot of data inputs.
Look, Anna, a lot of data. This was a number that everyone on this side of the world was waiting and looking out for. We have CPI data for the Eurozone, as you mentioned. Yes, the headline number went up a touch on an annual basis in April to 7%. But the number that everyone pays attention to, and a lot of this because of the guidance from the European Central Bank, which has really stressed that they look at core inflation dynamics, is that core inflation number, which now eases to 5.6% in April compared to 5.7% the month prior. It came in right in line with expectations, and I guess for some it could really support the case that maybe that core inflation pressure that we had seen play out in the past few months may have peaked and the trajectory is changing. On top of that, Anna, and you alluded to this, we had the lending survey for the euro area, which again on a bigger picture did point to some tightening in those financial conditions. Remember, the European Central Bank had also said they were looking at those for any fragilities that could feed from those banking jitters into the real economy in Europe.
Right. Well, core inflation in line then, but the headline number, which is the one that includes things that we need to buy in order to live, rises or is above the expectation and looks pretty sticky. What does that mean for the ECB, Maria?
Yes, and you know what, Matt? You make a very good point, because when you're in the financial world, obviously we talk about the core inflation, but when I talk to a lot of the normal people, they do say if you strip away the food, you strip away the electricity prices, obviously I would have much more money to spend on a daily basis, but that is where a lot of people on a daily basis happened to have, well, that pressure to provide for those two items. Now, Matt, overall, however, if you put the lending survey on one side and then you add the fact that core inflation did go down, even though you did see this pickup in the headline inflation, I guess you could argue that going into Thursday, the European Central Bank now has a few elements to actually go for 25 basis points to say core inflation has cooled. That lending survey does show that some of the jitters are feeding into some of the European banks, and that could call for cautions in the hiking. It is obvious that they will hike, but the question was, will it be 25 or 50 basis points? Again, you could say that will flip the argument to 25, but we'll have to wait and see, obviously, on Thursday in Frankfurt.
All right, Maria Tadeo, will you be in Frankfurt? Are you going to Frankfurt for this?
Yes.
Okay,
yes,
excellent.
tomorrow.
Maria Tadeo making her way from Brussels, the European capital, to Frankfurt, the ECB headquarters. Let's get back to the United States right now. President Biden has set a high-stakes meeting with congressional leaders for next week on the debt limit. This comes as the Treasury Department warns a potential default could come sooner than expected. Secretary Janet Yellen writing in a letter to lawmakers saying, quote, "Our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June and potentially as early as June 1 if Congress does not raise or suspend the debt limit before that time." Bloomberg's Valerie Teitel joins us now for more. So, Valerie, a warning from Treasury.
Look, a warning from Yellen that it could come as soon as June. I'm not sure the markets are prepared for that, and I think it's going to sap risk appetite for the month of May. Now, we go back to 2011's debt ceiling debacle just to get a picture of how volatile it caused the markets to be. The S&P fell by 15%, 10-year yields rallied to 75 basis points, and gold screamed higher. Now, what makes this case today different than 2011 is that investors are worried about not what the markets do trading into it, but what happens to the bond market afterwards, and I'll tell you why. The Treasury has fallen slightly behind on its issuance of long-term securities. At the same time, you're having a ballooning budget deficit due to the high interest payments that the Treasury now has to pay on its debt pile. This means that the Treasury could have to confront the market with a lot more long-term Treasury issuance. Just at the same time, we know that foreigners are pulling back, namely China, pulling back on their Treasury bond buying. So it could be quite a volatile time going in and a volatile time for the bond market coming out as the Treasury readjusts its supply calendar.
Okay, Valerie, so those are things we know about 2011 and how that could go and taking in Treasury issuance. On the subject of issuance, Monday's session saw a healthy amount of U.S. corporate issuance. What drove the debt-raising frenzy stateside?
A little bit maybe of relief that the First Republic situation is over. There was a huge amount of issuance yesterday, $22 billion worth of issuance, especially coming on today when half of the world was on holiday. 11 IG issuers came to the market, the biggest one being Meta's $8.5 billion bond deal, and it was the busiest session since February. Treasuries didn't really absorb it that well. We saw yields rising across the curve, especially in the long end. 10-year yields rose 15 basis points, caused a lot of the weakness follow through in fixed income markets across Europe today. But we're rallying a bit this morning in treasuries. That's a signal that a lot of the market has digested the supply.
All right, Valerie, thanks very much. Valerie Teitel will be watching for us, and we will check back in with her tomorrow morning for sure ahead of that Fed rate decision. Now, more job cuts on the way at Morgan Stanley in the midst of a deal-making slump. Bloomberg has learned that senior managers are discussing plans to eliminate about 3,000 jobs by the end of this quarter. Michael Moore, Bloomberg finance editor, joins us now for the details. So, Michael, what do we know about where these job cuts will be in which units?
Yeah, I think you're going to see it pretty broad, to get to that 3,000 number. But, investment banking is where the slowdown has really hit. Deal making definitely took a dive last year and has not shown signs of reviving so far in the higher interest rate with a lot of volatility in markets. So I think that's, where the focus is right now. We've seen other banks talk about job cuts. Lazard last week, Citigroup and others have talked about it. There was a little kind of pause in some of these hiring freezes last month when a lot of Credit Suisse talent came on the market, but it does seem like the economic picture is playing out.
So that's the Morgan Stanley story, in particular around investment banking. Let's just pivot back to what we've learned today with regards to the Asia and Europe giant that is HSBC. In European banking news, HSBC reported first quarter earnings this morning. The numbers themselves beat estimates, as we've been saying. The London-based bank also announced it will buy back as much as $2 billion of stock and will resume paying quarterly dividends for the first time since 2019. Let's listen to the HSBC CEO Noel Quinn, who spoke with Bloomberg after the results.
What I think we see going forward is continued sustainable profits and therefore the potential for a series of buybacks. We've always said that buybacks have a place, and they have a place alongside dividends to distribute excess capital.
Noel Quinn there, the CEO of HSBC. And so interesting then to think about this, Michael, in the context of the pressure that this bank has been under to satisfy demands, quite radical demands from one particular shareholder. Does this earnings report sort of read as a rebuttal, a riposte to the demands that they've been facing?
I think it does. I think HSBC has made the case that, we're profitable and we're making steps in the right direction the way we are structured now. Ping An obviously wants a dramatic kind of breakup of this firm, or at least that's one idea that is being floated out there. But I think, other investors are not, even if they're not on board on that, would like to see more capital return. So HSBC starting this buyback, bring back the dividend, I think that will help satisfy some of those shareholders that weren't all the way in Ping An's camp but had some questions.
Bloomberg's Michael Moore, thank you very much for joining us, talking to us about the banks on both sides of the Atlantic. We'll continue to follow those stories for sure. Let's take a look at some of the other stocks that we're watching here in the U.S. In the pre-market this morning, Chegg is a company you may not have heard of, but they provide tutoring services. They help kids, to get better grades. And the stock down 45% after warning that ChatGPT is threatening the growth of its homework help services. One of the most notable market reactions yet to signs that generative AI is upending some industries. Also, Lordstown Motors may be forced to cease operations and file for bankruptcy after manufacturing giant Foxconn told the electric vehicle company that it's prepared to pull out of a production partnership. You may be surprised to know that Lordstown is still an operating business. I have never seen one of their trucks on the road. Apparently, there are some. Nonetheless, there may not be many more as the stock drops another 20% in the pre-market. And Dell Technologies, those shares are up 2.3% in the pre-market as Morgan Stanley upgrades the computer company to overweight from equal weight. The analyst Eric Woodring saying that the worst of the PC down cycle is likely behind us, and he expects Dell to outperform the rebound in the PC market. Finally, Zoom Technologies, which is not the video conferencing company, but actually a marketing software as a service company that also collects data for you. It boosted its adjusted earnings per share guidance for the full year. The guidance beat analyst estimates, and so Zoom Technologies, which is an $8.7 billion company, is up another 5% in the pre-market this morning. Anna?
Okay, a lot of pre-market movers then to keep an eye on. Coming up on the program, we'll talk macro. Raffaella Tenconi joins us, founder and chief economist at ADA Economics. How much does the lending data and inflation prints out of Europe change her view on the ECB or not? We'll look ahead to the Fed, of course, as well. Plus, it's day 2 of the Milken Global Conference in Beverly Hills. More highlights from some of our interviews ahead.
We're anticipating a recession at the back end of the year, but the amount of pent-up demand, the amount of the strength of the corporates, the strength of the consumer coming into this, the usual amplifiers of a contraction are not in place. And I think we'll see the US economy, unlike others, pull out of whatever a recession environment could be pretty quickly.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York. Anna Edwards with us out of London. We are looking right now at the relationship between stocks, which I have highlighted here in blue. These are the S&P E-minis, and bonds. These are Treasury 10-year futures in white. Now, the problem that we've had over the last couple of years is occasionally these two assets get very correlated when you have a buy everything or a sell everything rally. And that leaves the 40-60 portfolio or 60-40 portfolio in a really bad spot. But now we've returned to the historic relationship between the two going in opposite directions. Joining us to talk about that is Denitsa Zakova, Bloomberg Cross asset reporter. So the correlation has gone away, I guess, thankfully for average investors, right, Denitsa?
Yeah, of course, if we look at the short-term move, this is 40-day, 60-day, it has actually turned negative since March. And of course, the banking turmoil played a role in this. Investors were looking for safety when it comes to treasuries, and that kind of shifted that correlation. And we've actually seen the 60-40 had a pretty good start of the year. It's up 6.6%. And of course, if that correlation remains negative, that will be a lot more good news for those balanced strategies, including risk parity and other similar balancing between the two. Of course, this will mean kind of a more traditional environment of risk on and risk off, which we didn't see in 2021 and 2022. This will mean going back to equities rallying and then bonds selling off. The two big factors for that are the Fed and inflation. So obviously, aggressive Federal Reserve policy was keeping that correlation positive for a very long time. Okay. And if that is still a factor, that correlation can go back to more positive territory. And if inflation remains very stubborn, we may also see that correlation going back to
so we'll watch that. One part of that then is what stocks do and who's buying stocks, Denitsa. And I know that quants, you've been looking at how quants are buying, but there's more skepticism elsewhere.
Exactly. So quants have practically been the only few buyers in stocks in the last few weeks. So systematic traders like trend followers, target volatility funds have been buying up stocks. Obviously, this is based on rules. And just because volatility has been so low, they were kind of pressured to buy stocks in the last few weeks. But when it comes to discretionary traders, which obviously show a lot more sentiment about the market, they have actually been sellers of stocks. And we've seen that reflected in sentiment. Sentiment has turned more bearish. Going forward, the implications of this is the support we saw from systematic traders may not be here anymore because they have been buying a lot of stocks, so they're quite overweight. And the second worst implication is that if there is a sell-off, they will be quickly turning into sellers and amplifying the moves downwards the same way they did upwards.
Denitsa, thank you very much. Bloomberg's Denitsa Zakova joining us there with the latest on the markets. For more market analysis, check out MLIV Go. That's where you find the Markets Live blog on the Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The ECB says banks curbed lending more than expected in the first quarter, while data this hour shows underlying inflation in the euro area eased for the first time in 10 months, backing the case for a smaller ECB hike. President Biden and the debt limits. He's called a meeting of congressional leaders for next week as Treasury Secretary Yellen warns that the Treasury may run out of cash as soon as June. And more job cuts on the way at Morgan Stanley. 3,000 positions will be cut as the bank grapples with a slump in deal-making. I'm Anna Edwards in London with Matt Miller in New York. And Matt, plenty of stories from the banking sector, as we've already discussed so far this hour. Meanwhile, futures stumble a little bit as we go in search of new catalysts, I suppose, for these markets.
Yeah, absolutely. Waiting for the Fed, after the RBA, may be concerned that the hawkish mood may run around the globe. Check out S&P futures right now, down about 0.2, a little bit less than 0.2%. It should be said that we've rallied up there. We're at 41.67 in the cash trade. Not a lot of movement yesterday, but relatively high levels and relatively high valuations as well. Interest rates are coming back down a little bit, although they came up yesterday. So remember, we were looking at the 10-year yield yesterday, and we were only at 3.45. Now we're at 3.5243, on the way back down by 4 basis points as investors buy some of that debt. The Bloomberg Dollar Index is on its way up. That's a headwind for stocks for sure, and right now it's only up 0.1%, but it had been down significantly earlier. So this is a real reversal. And then you've got Bitcoin hovering right around 28,000. It had come up back up through 28,000. It's now at 27,963 because it had fallen pretty substantially yesterday, 2 or 3% in yesterday's trade. Take a look at some of the pre-market movers. AI plays prominently into one of them, Chegg, which is I guess an online tutoring company. It says that ChatGPT is threatening growth on its homework help services. One of the most notable market reactions yet to signs that AI is upending industries. Notable because it's a 45% drop, I think. Lordstown Motors, which reportedly makes an electric pickup truck, may be forced to cease operations and file for bankruptcy after manufacturing giant Foxconn told the EV company it's prepared to pull out of a production partnership. You can see those shares down 25% in the pre-market, but it is already a penny stock. It only trades for 35 cents normally, or 40 cents at the close yesterday. Dell Technologies is up about 2.3% right now. Morgan Stanley upgrading the computer maker to overweight from equal weight. The analysts there, Eric Woodring, says the worst of the PC down cycle is likely behind us, and he expects Dell to outperform a rebound in the PC market. And then Zoom Info, which makes marketing software, data collecting software, and analyzation software, they are boosting their adjusted earnings per share guidance for the full year, beating the average analyst estimate, so up another 5%. It's already an $8.7 billion company. Anna, what do you see in Europe?
We see a bit of softness here in the European session then, Matt, as we get further into this session now, 2.5 hours in. Europe is a little weaker, down by 0.3%. And what is applying the biggest downward pressure? It is the energy sector. Some big energy names losing ground today. BP, the heart of that, down by 4.75% today. This as a result of, yes, the numbers were better than expected, but the buyback was smaller than had been anticipated. This business, these companies coming off record profits in 2022. So people looking for signs as to whether that is repeatable, and the way they describe the trading profits as exceptional, perhaps that suggests that they will not be repeated. So certainly that's a focus for markets. HSBC, though, providing something of a counterweight to the downdraft from BP. So we see that bank is up by 5% in London. Again, it's a story of better than expected numbers and a buyback, also reinstating the quarterly dividend. And the euro, 109.56, and we've been on quite a ride, Matt, today when it comes to euro dollar. And this is a lot weaker than the over 110 that we saw earlier on in today's session as a result of that Eurozone lending data, a survey of banks suggesting that credit conditions in the Eurozone had tightened. Will that mean that the ECB has less to do on Thursday?
Yeah, very good question. One that we'll put to Raffaella Tenconi right now. She is founder and chief economist at ADA Economics. And Raffaella, this I guess, is a concern not only for European banks and the economy, but also for the U.S. Are we seeing banks tighten up credit even beyond the tightening that automatically comes with higher rates?
Good morning, everyone. I'm not sure whether they're tightening even and beyond, but they're reflecting what the central banks are saying. Both the Fed and the ECB are still playing the hawkish tone, even though, if you ask me, the underlying data is already suggesting that they have done enough and they should just stay put at this stage. But Lending Standards survey for the Eurozone sent a very clear message. Investment is now beginning to soften over and beyond overall demand and the housing market. So the survey very clearly signaled that the ECB, any tightening from here onwards, it's going to backfire in terms of investment and eventual productivity gains.
Okay, so you already see some signs. Good morning to you, Raffaella. You already see some signs that, well, we all see that survey that credit is tightening, and you think that that means that the ECB does not have to do so much. Has that changed your thinking on what they do on Thursday, or were you always in the camp that they should either stay put or just do 25?
Well, no, we think that they will hike anyway on Thursday because they've communicated to the market, so it's not in their style to really surprise the market. So they will probably do 25 or 50. It's still completely plausible because they have 4% in their head as a key threshold. But the underlying data now for a month and a half, in our view, has signaled that they have genuinely done enough. Even though our forecast at the end of 2024 is not yet in line with the 2% target, but you have to consider that we are seeing all of the slowdown of money and lending activity right now. We still have a lot of geopolitics twists coming. We have the AI unfolding that will affect both inflation and the labor market. And we have the new fiscal framework in the EU, which will tighten fiscal conditions next year. So in my view, if you're a prudent central bank, now it's the time to pause and let the economy adjust to all of these moving pieces, which are genuinely really challenging for everyone to plan. But
Raffaella,
they've already committed.
Yeah. Okay, so they've already committed on that front. Over in the United States, Raffaella, I wonder how much an economist focuses on the debt ceiling debate. We just had a nice opinion piece written by Bill Dudley, formerly, of course, of the New York Fed. And he says that, I have one message for those observing or involved in the standoff over raising the US federal debt limit. Be afraid, be very afraid. So quoting heavily there from 1980s Hollywood. At this point, he says, in the financial and economic cycle, the consequences of failing to reach a deal would be particularly dire. As an economist, what do you watch for here?
Well, as an economist, actually, I think this is a war of attrition. So we think the market will be very nervous in the coming months, but we expect the deal to come at the very end, at the last minute, just because the conditions are so severe if there is no deal. In our view, it may be an interesting beginning of the election campaign that then really unfolds in the following year. And that, to me, is particularly important because it will shape taxation and fiscal matters in coming years. So it's, to me, the longer term issues are the most interesting. But from a market's perspective, the monetary policy, again, it probably would be justified to just stay on the line simply because of the volatility.
Raffaella, what kind of recession are you expecting for the U.S. economy? I've heard a lot of people say that they feel the recession coming is going to be short and shallow with a strong recovery on the other side.
We think that the risk of recovery in 2024 are really getting very slim. So if you look at our forecast and most of the consensus forecast, 2024 looks overall a better year with this lump coming at the end of this year, maybe at the beginning of next year. But in our view, the risk is that you get a slowdown that is more protected. And the next year is not necessarily a full contraction year, but it may be stagnation, so very close to zero. So that's another factor why, if inflation forecast already today in the US is aligned with a target, there's really no need to tighten monetary policy anymore.
Raffaella, thank you very much. Thanks for joining us. Raffaella Tenconi of ADA Economics. Coming up on the programme, the global chip race in focus. We're live in Dresden in Germany as Infineon Technologies breaks ground on a new semiconductor factory. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the Apple co-founder Steve Wozniak. That's at 12:30 p.m. New York time. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, the EU is aiming to produce 20% of the world's chips. Right now, it makes about 10%. Today, Infineon breaks ground on a new chip factory in Dresden, in Germany, the biggest investment in the company's history. Bloomberg's Oliver Crook has been speaking with the company's CEO.
This single biggest investment ever for Infineon. We are contributing to the digital and the green transformation. The products we're going to make here are crucial parts of the electricity chain, from energy generation to storage to conversion in charging, consumption in your electric car. And equally on the digital side, we're going to make it the smart IoT in this consumer industrial space going to happen. And of course, with this project, we contribute towards the target of 20% local production in Europe. We will reduce one-sided dependencies, and therefore it fits perfectly into the landscape.
And so there's funding for the industry, there's a lot of excitement, there's political will. What is still missing, do you think, in order for Europe to achieve what is really a very ambitious target?
I think the landscape is in place, and what it needs now is entrepreneurs to do what we are doing today and to make it happen and to realize and get going. The political framework does exist.
And so obviously these fabs are a crucial part of that, actually generating the chips, but also you need the raw materials, you need a lot of other things, you also need critically labor. Where do you have everything you need from that perspective?
Labor is going to be a challenge, even though Silicon Saxony now employs over 70,000 people in the semiconductor industry, so it's a good base. We have 9 universities and colleges in the area, but we need to invest. For example, as Infineon, we invest into vocational training, which is crucial for maintenance, right? These machines, which costs tons of money, need to run the whole day, and therefore right now we are educating ourselves, 250 people in vocational training for maintenance. So people are critical. In terms of material and machinery, I think we're going to get it done. We are aligning our plans very well with our suppliers, and therefore I think it's going to work out.
Oliver Crook joins us now live from Dresden. So Oliver, we've heard the goals and the aim. What is the significance of this project in German and in European terms?
Right, and so you'll have the Ursula von der Leyen and Scholz arriving here very shortly, really underscoring how much of a priority this is for them politically. And really, these are the chips that are the backbone of the future of the economy. So this is everything from EVs, from wind turbines, and all of these kinds of things. They need a huge amount of capacity in order to double what is already a very ambitious target. So Europe already consumes about 21% of the world's chips. It only produces about 10. And here in Saxony, they refer to as Silicon Saxony, maybe not a term you've heard a lot, but actually 1/3 of all the chips produced in Europe are produced right here. So in Dresden here, Infineon already has 3 factories. This will be the 4th. This is, as we've been saying, the biggest investment yet, $5 billion for the company. They're hoping to get $1 billion from the German government. And really, as I say, without these chips, you have no prayer in building the wind turbines, the digitalization, all of these things that Germany is really focused on getting strategic autonomy on for the future of the economy.
Yeah, and ensuring the supply chains of those chips are clearly crucial then for Europe, Ollie. We heard you there talking about some of the risks that there could be to meeting these ambitious goals around labour, raw materials.
Right, and so that was what the CEO was really stressing, were the things that the issues that they're going to have are around labor, are around raw materials, and if you have this sort of escalating fight with the U.S. and China, could there be unintended consequences? And the other thing he told me was really what he'd like to see more of is a more coordinated approach throughout the Western world and through liberal democracies. It's a lot of the same conversation we heard around the Inflation Reduction Act, where you have this risk of a sort of race to the bottom, where you're all competing for sort of the same materials, talent, investments from all of these companies. And again, also the labor, as we were mentioning. But also we should mention one other thing, that these chips here, these are the ones that they're going to be sort of building here in the new fab. These are key for the backbone of all of these parts of the economy. But what they are not are the hyper advanced chips that Intel, TSMC built. And that is still a whole, you are not going to get away from the dependence from those hyper advanced chips through just these.
Okay, at least these ones are big enough we can see them on TV, though. Oliver, thank you very much. Bloomberg's Oliver Crick in Dresden with the latest on Europe's ambitions in the chip space. Coming up, we will talk more about the earnings stories that we're covering today. Ford is out with earnings later. We'll get a preview what to expect from the car maker next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, Citigroup CEO Jane Fraser says the U.S. financial system is fundamentally sound, and in her opinion, just a handful of banks were poorly managed. Fraser spoke with Sonali Basak at the Milken Global Conference in Beverly Hills.
It's always a sad day when you see a bank fail. But we are all very pleased to get the major source of uncertainty that was remaining from the recent bank turmoil addressed. And that is a good thing, because fundamentally the US financial system is sound. This is a case of a small handful of banks that were poorly managed. And getting this addressed is very important. When we stood up, I think it's a statement that the major banks, the 11 major banks in the country, in 30 hours, put $30 billion to work to buy the time to get the right solution and answer put in place. And that was our intention. It wasn't to provide the answer. It was to give the time for confidence to get restored and our regulators to do their job, which they did.
With First Republic being out of the way now, certainly that was the whale in the room, but what do you expect next in terms of any future bank failures or even hiccups down the road?
So I'm more optimistic around it. I do think the U.S. financial system is extremely strong. The large American banks globally are in an enviable position. Our financial system has a particular structure to it. The large banks, the regional banks, the commodity and community banks. Everyone plays a different role. We play different scale, different customer bases, but it's a strong system. I am anticipating there will be some more consolidation. We do have over 4,500 banks, and it's likely that the minimum efficient scale will rise, but I don't think that brings into question a system that is the envy of the world. This is a strong and highly desirable financial system.
Now, Citigroup CEO Jane Fraser speaking at the Milken Global Conference in Beverly Hills. Our TV and radio team will bring you more interviews from that conference throughout the day. Now, for a look at what else is ahead today, let's have a look at what is in the diary. Before the US market open, we get earnings from Uber. Then later today, an interview with Uber's CEO on Bloomberg TV. That's at 12:15 Eastern Time. The Federal Reserve begins its two-day meeting on interest rates today. We get the decision tomorrow, of course. Key US eco data includes JOLTS, job openings data, factory and durable goods orders. And Matt, Ford reports earnings after the bell, I'm told.
I'm very much looking forward to Ford earnings after the bell. Wait, after the bell? Before the bell? Is it after the bell? Is it? Oh. After the bell, okay. Investors are going to be looking for clarity on how the automaker will reverse losses on EVs that could reach $3 billion this year. And we get a ton of other earnings. Stellantis tomorrow, BMW and Volkswagen on Thursday. It's a hot week for automakers. Craig Trudell, Bloomberg's Global Autos editor, joins us now for more. So, Craig, why don't you just tell us first what you expect from Ford and then, the industry at large?
Yeah, so this will be our first look at forward earnings since they sort of switched up how they're going to report earnings going forward. In the month of March, they for the first time gave a look at their books broken up for the electric vehicle business and the combustion engine business. And it's really a tale of distinctly different states of affairs. The electric vehicle business is, of course, doing a lot of investment. Batteries are still much costlier than combustion engines, and so you see, an expectation for $3 billion of losses in that business for this year. We'll get a first look at the first quarter for that side of the house. There was a setback in terms of a stop sale for a moment for the F-150 Lightning that I'm sure will be closely sort of looked at for the first quarter. But also, you just generally have heard a lot of, blunt talk on the part of Jim Farley about, needing to be more competitive, bring costs down. And, I think, GM set the bar fairly high last week with a beat and a raise for the year. Of course, all the talk as well about Tesla and pricing on the EV side will certainly be a hot topic as well.
Okay, yeah, that is going to be interesting, isn't it, Craig? Because I was going to ask you what's going to stand out from the European names that Matt mentioned, and there are a lot that will report this week. And pricing at BMW is something that Bloomberg Intelligence references as being interesting. What are you focused on from the European story?
Yeah, I think it's going to be interesting to hear, we'll probably hear a lot of, we're not going to engage in price wars, and a lot of pushing back on this idea that, they're going to be sort of lured into, going blow for blow with Elon Musk. I think it is going to be difficult for these companies to resist, particularly in certain segments. Ford being a good example where they had little choice but to bring the Mustang Mach-E down because it competes so head-on with the Model Y, which has become so much less expensive so quickly. We may see some more, reductions there. On the other hand, the F-150 Lightning, we know that this is a model that, does not have the Cybertruck to compete with, won't anytime soon, at least in scale in terms of, Tesla making quite a few of those. So, we've actually seen them move the prices of those up. So it's going to be a different story depending on the segment.
I mean, I price out an F-150 Lightning on the configurator, and I can't get much lower than $90,000. Same is true for the BMW iX, a $90,000 electric family truckster. So the prices are incredibly high for these electric vehicles, but I have to say they are impressive to drive, Anna. Craig, thank you very much for joining us.
Okay, so pricing still remains a focus. Craig, yes, indeed. Thank you for being with us this morning. That is it for Early Edition. Surveillance is ahead. They'll be hearing from Gerard Cassidy of RBC Capital Markets. Lots more to discuss coming up on Surveillance. This is Bloomberg.